we turn to Sam Stovall, CFRA Research Chief Investment Strategist, a great guy with stats on the market as well. Sam, it is great to see you. I want to start where we were just talking about, what Josh was just talking about. That is this broadening of the rally that we have started to see. Do you think that continues, and does it indeed mean that more gains are coming here into 2024?
Hey, Julie and Josh, good to talk to you two again. Yes, I think that 2024 is going to be a surprisingly good year. Historically, good years follow great years. We've actually seen an improvement in the average price change by 200 basis points, an improvement by 10 percentage points in terms of frequency of advance after a 20+% gain. So that's the first thought. Second thought is this is the election year. First-term administrations, usually they're up about 15.5% on a total return basis, with every one of those years being positive. So again, another positive indication. I think we might, however, be getting a little bit overbought in terms of percent of sub-industries above their 50-day, stocks above their 50-day, the CNN greed fear factor being at extreme greed levels, et cetera. So I think maybe a post all-time high pause. But as Josh said, nothing really to fear because the next decline of 5% or more will probably come about 10% after a continued advance and would not likely lead into a new bear market.
So Sam, maybe some near-term overbought here, but looking ahead, some potential strong tailwinds. I am interested, Sam, after you've seen the rally like this, how does valuation look to you? Does that still look attractive even at these levels?
Well, at 20 times forward 12-month earnings for the S&P 500, it is higher than the long-term average, which is about 17. But I think because investors are anticipating an end to the rate tightening program, expecting to see the first cut, the street is looking for the first quarter. I think that the Fed's going to wait until the second quarter. But still, the market tends to advance about 14% in that 11-month period between the last rate hike and the first rate cut, lifting all boats, if you will, in terms of sizes, styles, sectors, and sub-industries.
Are there those that particularly stand out, though, as doing better in that kind of a scenario, Sam?
Yes, well, financials are one of the groups that tend to be outperformers in this Fed pause period. Real estate also does fairly well. And so I think also that taking a look at the groups that has done so well this year, they will likely carry over into 2024. History tells us that following a down year, you want to buy last year's losers because they're the ones that have the most to recover, and that's what we saw in 2023. But following an up year like 2023, you want to let your winners ride. So consumer discretionary, communication services, and tech, but also the honorable mention as found in industrials and financials.
So Sam, those are the sectors, as you said, let the winners ride. Which are the sectors, Sam, as we head into 2024, that you find less attractive here?
Well, less attractive. I still think that there's an awful lot of headwinds to be found in consumer staples, healthcare, as well as utilities. Utilities, might see a little bit of a pop because they have fallen by 11% on a year-to-date basis through last night. The worst performing sector. They do offer a nice dividend yield, but I think if investors are re-gravitating toward growth, they're going to do so at the expense of these very defensive categories. And only if we do think that a hard landing is likely, which we don't, then I think we will not see a rotation into defensive areas that will just let those winners ride.
Sam, I'm also curious to sort of circle back to the idea of the Magnificent Seven, which had been so dominant this year. Before that, it was FANG, right, as our popular acronym. Is there something that you think it's going to go towards in 2024, and we'll come up with another sort of cutesy name for?
Well, I'm sure we're going to come up with a cutesy name by all all means. I don't have one at hand to offer. While I do think that on average the top three sectors going back to 1990, following an up year, if you stuck with them, those three on average outperformed the market 70% of those years. But I mentioned earlier honorable mention. So financials and industrials, these are showing good relative strength. They are showing positive earnings growth expectations, more attractive valuations. So even the regional banks, as well as some of the investment bank and brokerage categories in the financial side, as well as the industrial machinery areas and building products are expected to do fairly well. So, you don't want to be bottom picking at this point because there's just too much overhead resistance.
Sam, one trend we saw in 2023, investors sitting in cash, and listen, for good reason. Do you think, Sam, in 2024, would you expect to see investors really pull out of those money market funds and put that money to work? And where do you think that money would flow to? Would it be equities, bonds, both?
Well, yes, I do think that we will see some money because, in my opinion, there's really only one emotion when it comes to investing: fear. Fear of losing money on the way down and fear of missing out on the way back up. So what we are going to see is just a trickling in of the money that's on the sidelines. Yes, it's earning 5%. Yes, it is fairly safe. But I think investors are going to say, well, wait a minute, I don't want to be left behind. I want to be taking advantage of these strong price moves as well. So I do think that that's why the bull market takes the stairs rather than the elevator as the bear market does, mainly because little by little investors throw in the towel and decide to invest the money that's on the sidelines.
Sam, it was great to have you on the show today. Thank you so much for your time, your insight, and Happy New Year.
Thanks. Happy New Year.